Good Monday morning and welcome to Opening Bid. I'm Yahoo Finance Executive Editor Brian Sozzi, and you thought this year was going to be smooth sailing for the stock market. Think again. Federal Reserve Chair Jerome Powell revealed Sunday night that the Justice Department served the central bank with grand jury subpoenas threatening a criminal indictment related to his testimony before the U.S. Senate. At issue, the central bank's renovation of its Washington headquarters and whether Powell lied to Congress about the scope of this project. Markets are back in sell America mode after this one. Stocks are under pressure, bond yields are up, and gold has caught yet another bid higher. In a video statement, here's what Powell had to say.
I have deep respect for the rule of law and for accountability in our democracy. No one, certainly not the chair of the Federal Reserve, is above the law. But this unprecedented action should be seen in the broader context of the administration's threats and ongoing pressure. The threat of criminal charges is a consequence of the Federal Reserve setting interest rates based on our best assessment of what will serve the public, rather than following the preferences of the president.
Most investors alive today have never seen something like this before. If you are a Gen Z investor just trying to save for retirement and do some profitable trading, you for damn sure have never seen anything like this. Here are 3 reasons why this matters in its most simplest form. The bedrock of the Federal Reserve is its independence to make decisions on interest rates. Challenge that, and the bedrock begins to crack. And then that could spread to the financial system. You do not want cracks in the financial system, obviously. The bedrock of said financial system is trust. Trust the Federal Reserve is independent and trust in transactions. If trust begins to erode, well, replay what I just said, rewind it back. Whether one likes it or not, the bedrock of the U.S. financial system is debt. It's how the economy runs. Investors all around the world trust the U.S. government will make good on its debt obligations. If global investors lose trust in the ability to service debt, in part because of a view of a less credible Federal Reserve, it will raise the cost of capital for the U.S. and many companies. That sets off a series of ugly dominoes one would rather not see pushed over. You just wouldn't want to see it. Let's bring in the opening bid roundtable to weigh on all of this, really an unprecedented day. Matt Stuckey, Northwestern Mutual Wealth Management Chief Portfolio Manager of Equities, alongside Yahoo Finance Fed correspondent Jennifer Schomburger and senior reporter Inez Ferre. Jen, I want to come out with you here. Really a situation, like I mentioned in the intro, not a lot of folks have seen before. I think they're trying to figure out, 1, what exactly happened here? And then number 2, what is next in this?
Yeah, so this looks like a way for the administration to pressure the central bank in a very unprecedented way to lower interest rates. And you saw Chair Powell come out in an extraordinary recorded video message Sunday night, essentially calling that spade a spade. So what comes next is, does the investigation now, or does the grand jury bring criminal charges against Chair Powell? It hasn't been said who is going to lead this investigation here in Washington, but there is a sense that it could be the U.S. Attorney Jeanine Pirro, who is an ally of President Trump, and she sure does not mess around. And so if she is in charge, I would expect charges to be brought against Powell, probably on some sort of technicality. Now, the issue here is that the administration wants lower rates, therefore they're trying to push Powell out. However, that could backfire because we're already seeing reaction this morning in the bond market. It could also make Chair Powell dig in his heels further. While his term as chair is over in May, his term as governor is not over until 2028. So that begs the question, will he stay on through 2028? And that means then the president has less openings to appoint a new Fed chair. He would basically have to use Governor Myron's spot to then appoint a new governor and then elevate that person to Fed chair. So then that also begs the question of, hey, if there is an issue with Fed independence right now under Chair Powell, does that continue under the next Fed chair? This is sort of a warning shot, which is, if you don't do what the administration wants, will you face a criminal investigation? And that means that every single inflation report that we will be getting takes on that much more importance.
Matt, you are the money person on this panel. Question 1 to you. Do you sell America off this?
No, I don't think you do. I think the sell-off this morning is a little bit of a reflection of kind of where valuation multiples are and kind of where credit spreads are. We're at near 15-year tights in terms of where credit spreads sit today, meaning that there's not a lot of systematic risk priced into the equity market. And you get a headline like this over the weekend, and there's going to be some adjustment to that valuation. But there's a lot of positives still with the U.S. economy. Earnings are rising across the equity landscape, from small caps all the way up to large caps. And we're heading into earnings season where we're likely to see another quarter of double-digit earnings growth year on year. And so those are positives that I think can counteract some of the, let's call them, somewhat, discouraging headlines that we've seen over the weekend.
Question 2, Matt. Folks that I've talked to on this in the past, in the morning so far, have pointed out a potential rise in inflation expectations on the view that the Fed's independence is now in question. If that's the case, if we're going to get a rise in inflation expectations, what stocks work and what won't work?
Looking at the longer term risk, you just underlined it well there. The loss of independence from the Fed kind of comes with an unanchoring of inflation expectations. On the positive side, what you've seen in markets the last couple of months is inflation expectations moving lower, as we've seen some of the outlook for inflation improve as some of the tariff headwinds have been less than expected. But if you're looking at a way to hedge the upside to maybe that changing if inflation expectations were to rise, real assets are your hedge there. So think commodities, think energy stocks as a way to kind of hedge some of that inflation risk if it were to reverse and head the opposite direction.
And it's almost as if the markets sniffed all this out. Those investors in hard assets like gold, silver, commodities, they almost sensed this was coming. I mean, of course they didn't, but you know what I'm trying to say. So gold, to that end, has caught another bid today.
Yes, and metals bulls are saying that it is going to go higher. I mean, you're seeing commentary about this being an assault on the Fed. This is destabilizing, and that's why you are seeing investors flocking to safe haven assets. So you're looking at gold at all-time highs. You're looking at silver also that has been rallying hard. And for the first time, just want to point out, since 1996, you've got foreign central banks that are holding more gold than U.S. Treasuries. And I saw one strategist saying the debasement trade is real, that debasement trade that we were talking about last year. And keep in mind that these moves that we're seeing today are on this question of Fed independence, but also you are seeing geopolitical tensions, which have also been feeding into the precious metals rally. You had HSBC just days ago saying that gold could reach 5,000 because of, in the first half of 2026, because of geopolitical risks and rising debt. So now gold is not just trading as an inflation hedge, but it's also trading because of these geopolitical tensions as well.
Jen, one of the first things I thought of when I saw this news cross, and it was late, you got that alert. This is the last thing you want to see late Sunday, this type of alert cross the screen. But my first thought among many was, wow, this is Kevin Hassett's job.
That's what Polymarket has certainly been pricing in, and I think that's what investors have been pricing in really since the get-go. So I don't think any surprise there, but to your point, yes, the president wants somebody in the Federal Reserve chair spot that he trusts will be loyal to him. And so Hassett would obviously fit that. He has said, the president has said that he is in the top two. He likes the two Kevins. The other one is former Fed Governor Kevin Warsh. The president expected to make an announcement either before he heads to the World Economic Forum in Davos on January 21st or right afterwards. So we'll see how this plays out.
Jen, you've been covering the Federal Reserve for years. Have you ever seen a Federal Reserve video statement like this before?
No, I was shocked last night when I was alerted about this message. And to even be in this situation is completely unprecedented. I don't think we have really seen this in the modern era whatsoever. It seemed that Chair Powell had tried in the past to sort of quell some of the president's threats, the administration's threats. The fact that he came out with such a strong statement and on video nonetheless was really a shot across the bow. It almost feels like we are in an outright war at this point. Typically, Treasury Secretary Scott Bessent has sort of pushed the president to ease back a bit on this. Now, the president has denied any knowledge of this, the grand jury subpoenas. And Kevin Hassett said this morning that he doesn't believe the president has been briefed on it, which is quite interesting. Nevertheless, this is an unprecedented moment. We'll see if Bessent or other Republicans in Congress come in and sort of take an off-ramp here, if you will, to sort of quell things down. Because to your point, as you mentioned earlier in the show, central bank independence is really the bedrock of a strong economy. And if you don't have that, then you're going the way of, dare I say, Venezuela or Iran.
Oh, wow. All right, well, we don't want that, Jen. Matt,
that's a far-fetched scenario.
Yeah, no, but I get it. I hear where you're coming from. It's just a lot of things going on Monday. Matt, my question to you is this. Is a loyal Fed chair good thing for investing? A Fed chair that is loyal to the president, essentially.
The best Fed chair is one that has the interest of the economy in front of us for the American people, and that means a long-term North Star of keeping inflation expectations anchored around 2% and maximizing full employment for Americans. And so that's I think going to continue to be the goal of the Fed. And as a reminder, the chair is just one voting member. There's a variety of different members on the board.
Matt, do you think this news could be the start? And we never know until after it happens, but this is that event that causes a rolling correction in markets. Bond yields higher, flight to safe haven assets like Inez mentioned in gold, and then equities have to adjust for this higher risk premium.
No, I don't think so. I think the earnings power of corporate America continues to strengthen, and we've seen that strengthen since the second quarter of 2025 and accelerate into year end. That would have to reverse in my mind for that cascading effect for a downward move in equities, and that's just something with earnings season in front of us that I don't think is a high likelihood.
And as
Brian, could I just add?
Go ahead, guys. Go ahead.
I just wanted to add a quick comment, which is, we're so concerned about central bank independence this morning, given the actions that we learned about overnight. However, if Chair Powell were to stay on as governor, perhaps the rest of the FOMC coalesces around Chair Powell and sort of tries to protect central bank independence. The same thing if we have a new Fed chair, when we have a new Fed chair come in, does the rest of the FOMC really stand in division with that chair? We know there are a lot of hawks on the committee, so let's recognize that this is a 19-member committee. This is not a committee of one.
No, that's a really good point, Jen. And Inez, really key to the market rally over the past few years has been the FOMC has been, they've rallied around the Fed chair. I mean, that's been key to the investment thesis.
Yeah, completely. Look, I think what Powell did on Sunday night was basically call checkmate on Trump. And so this has been sort of calling into this question the Fed independence. But Wall Street has also been talking about this over the last year and also putting into the expectations for what will happen with the markets. Look, you still have the AI trade. You still have tech that's supposed to power. That you still have earnings. You still have strong balance sheets. So we have to take everything into an entire consideration. But that doesn't take away the question, of course, of Fed independence and what this means for assets like the metals markets, like we've seen.
This was great analysis on a very complicated situation. Big thanks to the opening bid roundtable. Appreciate it. Coming up, my conversation with top Wall Street deal maker Andrew Bednar, CEO of Perella Weinberg. We'll be right back. The fresh battle between Fed Chair Jerome Powell and President Trump is so important because at stake are two things. One, trust in our financial system, and two, the Fed's ability to properly set interest rate policy based on an unbiased view of the economy. Trust in interest rates are the bedrock of deal making on Wall Street. Upset either component and deal making could get whacked. This is deal activity is finally picking up, something you will hear on the earnings calls of big banks like JP Morgan and Citigroup this week. I talked to top deal maker Andrew Bednar, the CEO of Perella Weinberg, in a new episode of my Opening Bid Unfiltered podcast. Here's what he told me about the outlook for deals.
through my career, 31 years, we've had markets for sure where the receptivity to transactions was lower and the degree of difficulty in getting them done was higher. I would say today we've got the equivalent of, perfect ski conditions. So if you think about the three biggest factors in driving M&A, we've got a very strong equities market, we've got a strong credit market, and we've got a very accommodative regulatory regime in Washington. So those three components, I think, come together and create very, very favorable conditions for more transaction activity. And I think what that does is then gives CEOs a lot more conviction. Because don't forget, we're in a business that's not a prediction market. We're in the business where it's a conviction market. So it's not as though you're putting on a stock trade or taking a position on a binary outcome. You're actually going to have to make a long-term decision where it's not so easy to get out if you're wrong. So unlike stock trades, you can kind of get out quickly. This is more like building a house. And once you get in and spend a little bit of time there, if you want to sell it, it's going to take time. It's not as liquid, and there's consequences to that decision. So CEOs need a lot of conviction to get these things done. But we always ask with our clients, because we're less transactional in how we approach our client relationships. We're there with our clients through thick and thin. A lot of things that we do for clients are behind the scenes and not related to a specific transaction, but we are helping them on their most complex strategic and financial challenges. And sometimes that does lead to transactions. And the first question we ask is, what are we solving for? Mm-hmm. So what is our CEO focused on? Sometimes the CEO is focused on growth. Sometimes they don't like their evaluation. Sometimes they feel threatened by a market or a technology. Sometimes they're under indexed to a certain aspect of their business. And sometimes they're in financial stress where they have to think about, balance sheet. And balance sheet may involve reshaping the portfolio where we have to sell something. It may involve a merger, or it may involve new capital coming into the system in the form of equity or hybrid or a debt security. So we cover that entire range of services for our clients. So really, again, my initial answer, now I've gone on very long, but my initial answer was it depends.
Does the CEO, do they want to pull the trigger on a big deal next year? Or we're still living that environment where the CEO may want to pull a trigger on something, let's say, in the $5 billion to $10 billion range?
I think what's happening right now is that as bigger deals get done, it changes the whole frame of reference for a CEO and for their board. And so what a CEO and board may have thought was a big deal at 2, 3, 4, 5 billion now is seeing 15, 20, 30 billion and saying, are we thinking big enough? So CEOs are taking a step back and saying, if we're going to go through all of the work, all of the analysis, all of the risk, all the disruption, and all the ancillary issues that you have in connection with a large-scale merger transaction, is what we're doing worth it? And I think that's an important change in the dynamic this year versus what we had seen certainly in 22 and 23, which were relatively weak M&A years. 24 was a good recovery M&A year, and 25, as I said earlier, it's a spectacular year, and the conditions are very, very ripe for, I think, continued large deal activity. But just to keep it in perspective, there are thousands of M&A transactions a year, and there's about 70, 70, that's it, 70 above 10 billion. But when you start seeing, what was last year 30 or 35, and now that cohort of transactions is double. Every CEO that we're talking to is asking the question, are we thinking big enough? And I think that's a very important change as we head into 26, where I think those conditions I mentioned earlier, equity markets, credit markets, and regulatory regime, I think all of those stay in place for 26.
Is, not to ask the canned AI question, but is the AI going to force the hand of CEOs to pull the trigger on these big deals like you're talking about, just because this is such a disruptive technology?
It's certainly, I would say, a disruptive technology. It's a game-changing technology. It's also, I think, a job-eating technology. And we have to be very mindful of that. I haven't seen a CEO, haven't heard of a CEO saying we need to do something because of AI, other than those that are in the direct line of fire with the AI technology. But our clients that are outside of tech are not scrambling to do deals because of AI. I think they're continuing to implement AI into their organizations and into their supply chains, into their labor force, whatever their focus happens to be with AI. And it is changing the way business is done in every client that we are blessed to work with. So I think that is a trend that will continue in our own organization at Perella Weinberg. We are implementing AI. We have, I would say, 3 phases of that. The first was really just to give all of our teammates an AI assistant, which seems simple, but we can't take it off the shelf because, number one, we're a highly regulated business, so it's not so easy to just put these things in the field. Secondly, we're insanely focused on confidentiality.
Of course.
And so we just can't afford any little hiccup, not even, a gnat's eyelash off the mark on confidentiality. So when our IT team told me that we can now solve for that, then we allowed it into the field. And now we're in the second stage, which is really efficiency. And so we're training the AI assistants now to be much more finance savvy and to be much more responsive to the things that we need as finance professionals. And then the last stage will be productivity, which I think we're still quite a bit of ways off from, where it could actually help us with some idea generation and with thinking, around the corner with our clients. But right now we do no work that is client facing for our AI technology. We do nothing that faces the client. I'm just not comfortable with it yet.
For 2026, where do you think the big deal could happen? I almost feel like people have forgotten about industrial companies.
Yeah.
I mean, we've been so focused on these big 7 magnificent tech companies and what they are doing or not doing. There's 493 other companies out there. A lot of them are great industrials. They generate a lot of cash, and they're trading at multiples well below the Mag 7. I mean, there has to be value. And from an industrial perspective, and there might be an opportunity for even carve-outs because their company's not being valued properly in this crazy market.
Yeah. I mean, everybody focuses because of the natural concentration of the S&P and the Mag 7, but you have 150 companies. They're actually over 100 billion in the S&P 500. A lot of them are industrial companies. So I think you're spot on that there's consolidation opportunities within that market, but also even below $100 billion companies. Then you have several hundred that are actually going to be above 5 and 10 billion that have tremendous opportunities for consolidation. So the old business of things that you can kick and throw in industrial America and in global industrial businesses, I think those are ripe for continued M&A activity, and we see that opportunity. I think you're going to see more in tech. I think you'll see more in healthcare, and I think you'll see more in energy. And those are the typical triumvirate of M&A activity has been around those 3. But also, you've seen a lot of activity in financials. You again have an accommodative regulatory regime for bank consolidation, certainly at the regional level that's happening. So I think in the 26-27 timeframe, you're likely to continue to see broad-based consolidation. I couldn't tell you right now that I favor any one market. I think they're all very active.
Straight ahead, Julie Hyman will take the baton on Market Catalyst. Your investing day is only just getting started.